Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and let's go ahead and get started and take a look at where markets are trading. Now, before we get started, what we are going to discuss here is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll take a look at the major equity indices and see the changes that we have seen over the past couple of weeks, including what we've seen in the fixed income markets and the commodity markets. And then we'll take a look at sector rotation as we see some rotation, but not a whole lot. And we'll take a look at some subsectors on the move. And then we'll look at some opportunities in the bullish category and some opportunities in the bearish category in this particular market. But if we start with the S&P 500, we still very much remain in a long-term uptrend here for the S&P 500, but we've had a pretty, I would say, sizable correction or pullback here over the past few weeks. And this correction has obviously started to accelerate. We first broke below the 21-day moving average, broke below the 50-day moving average, bounced all the way back up to the 21-day moving average, and then bounced back to a prior support and actually broke this prior support here just over the past couple of days. But I will say what we're starting to see a little bit of is a deceleration of this move here to the downside. And even though yesterday's selling was fairly extreme, we did see that it basically held some of the prior support levels that we have held intraday over the past few weeks. So right now, our expectation is to look for a short-term bounce here. And the question is whether we can get back above this 433, 434 level here or so. If we can get back above this level, we can make it all the way potentially back up to the 50-day moving average. But long-term, momentum certainly has started to turn negative here. There is still some further downside to go here on the longer-term chart. If we break below the moving average here on the longer-term chart, the blue moving average, then we are potentially headed for significantly lower here. So this is something that we are watching here right now, but temporarily we might see a little bit of a bounce here. And we'll have to see how markets respond to those bounces. If they start to look weak as we approach these moving averages, we've now had the 21 cross below the 50-day moving average, then we could potentially see some further weakness here. So bearish momentum has decelerated, so our expectation is not for a strong amount of selling necessarily going into today's market. But if you look at the NASDAQ, things do look a little worse here on the NASDAQ. NASDAQ, after very similar price action, broke below the support level here a few days ago and started to accelerate here to the downside. But as you can see, the NASDAQ also has reached prior support here, and our expectation is that we could see a little bit of a bounce. And the question is, again, if it bounces back up to the 360 level, does it break above it? Or does it get bounced lower here? Now, that's really where we have to look at some other markets to help make our inform our decisions. But if we look at the IWM small caps, this is really where the fact that small caps have not sold off along with the markets and actually has made higher lows is constructive here overall for the markets, meaning it's less likely to see a significant downside because of the fact that the rest of the market is actually improving. Small caps are not continuing to accelerate to the downside. If you look at RSP, which is the equal weight S&P 500 indexes, you can also see higher lows, not making new lows like the S&P and the NASDAQ are. So what this really tells us is that it's the major mega cap names that are dragging the S&P and the NASDAQ 100 lower. But if you look at the most of the stocks in the market, they're not accelerating to the downside. They're actually finding higher lows. And that is generally overall constructive here for the markets. One thing that I do want to point out here is growth versus value. And we talked about growth versus value earlier in the year because growth versus value has been, value has been underperforming growth for multiple years. And then earlier this year, we started to see value outperform growth for a short period of time. It didn't last very long, and growth started to outperform value here again. But we're back at this level here again. And today we just broke out above this, where value started to outperform growth. And the question is whether this time is different or this is just another selling opportunity, as we've seen over and over again over the past few years in terms of where growth outperforms value. I think some investors do feel that this time is a little different and that we will see value start to outperform growth a little. So this really starts to frame our views in terms of equity direction, and where you want to maintain exposure here within equities. The other thing that started to improve here is the percentage of stocks trading above its 50-day moving average improved to 41%, while the S&P and the NASDAQ are trading at relative lows over the past few months. But as you can see, over the past few months, the number of stocks below the 50-day moving average has been much lower, in the low 30s, sometimes even high 20s or so. But the fact that now it's trading at 41%, or it's sitting at 41%, is actually an improvement while the S&P and the NASDAQ break lower here. So again, when we look at this on balance and you look at the participation of the sell-off, you're not actually seeing a lot of participation in the sell-off. It's really just the mega cap names, Apple, Facebook, Microsoft. These types of names are the ones that are taking the hit, and those are the ones that are dragging the major indices lower, while the majority of the stocks that sit in those indices are not actually necessarily accelerating to the downside. And that is, generally speaking, again, relatively strong for the markets. And then when we look at bonds, bonds had this very quick sell-off from the top end of the range, broke below the bottom of the range, and then for the past few days, as equity markets continue to look weak, or weaken, if you will, bonds have basically traded sideways. Now, it's still below this 146 level, so this is still roughly still bearish for bonds, but so far it's finding a little bit of an equilibrium, perhaps before it continues to sell off further. But so far, bonds have held up, and that's why, again, my expectations here over the next few days is not necessarily for the equity markets to further accelerate here to the downside. We're not seeing bonds sell off. We're not seeing that panic in the market, if you will. And for those reasons, that's why I think equities can find a little bit more stability here. Interest rates have held relatively equilibrium here, around 150 basis points. My expectation is that you could see a little bit more consolidation before yields potentially rise here again. The dollar index also breaking out above the $93, $94 level here. Sharp move here to the upside, pulled all the way back to the support level. This is another opportunity to look for further upside here for the US dollar. And that translates the downside here for gold. As we can see, gold continues to be on this long-term downtrend here. After what has been a very choppy trading session for the past few months, really, for gold, my expectations is for gold to continue moving lower towards this 161, and then potentially as low as and potentially as low as 157 or so here to the downside. And then to the flip side, crude, we've seen a substantial move up here in crude. And this is really where we have to go pretty far back to look at where crude is, because we're at pretty much relative highs over the past few years. We really have to go back to 2014 to see the prices that we are currently trading in. And this is really due to the supply constraints that are currently making its way through the markets. We have some extreme demand conditions out of Europe and in China. So this really starts to target potentially $100 here to the upside when we look at a long-term price here of crude, especially after it broke out above 76. So far, these supply constraints do not seem readily solvable in the short run, and this is going to continue to put a squeeze here on oil prices. So this is supportive of energy stocks. Coal stocks, we've seen those stocks outperform here over the past few weeks, and our expectations is that they actually will likely continue to outperform here until some of the supply or demand constraints here for oil ease, and that's not looking likely here in the next few days or next few weeks. When we look at sector rotation here, we see a fair amount of rotation. We have, 5 sectors that are improving, 6 sectors that are leading, 6 sectors that are lagging behind. You still have energy and financials in the leadership position. We do have industrials and materials coming up, but I'm not sure how long these will stay. These could very well start to turn back around, like we've seen here with staples that turned around, started to come back again. You have consumer discretionary that is losing ground and just entering into the weakening category here. You have healthcare taking a big step back, technology taking a step back, real estate taking a step back, and then you have communications and the utilities starting to show a little bit of strength here. So you have some sectors starting to move in the right direction. Utilities looking like it's just a couple of potentially days away from getting into the improving category here. So overall sector rotation looks fairly strong. If we look at the sectors with the watch list here in options play, you'll see that right now industrials, communications, materials, staples, utilities, and healthcare all have bearish trends. Technology and discretionary also have a relatively stronger relative strength, but starting to turn lower here as well. The only thing you really see is financials and energy. Those are the 2 sectors that are strong, that have green arrows telling us we have bullish trends. And then real estate is the strongest sector that is starting to turn lower here. So we really have a big mix of sectors, but as you can see, the vast majority of sectors are looking fairly weak here. Now, you can think of this as more of a contrarian indicator here as well. The more, if every sector started to turn red, that would be in a severe sell-off here. And severe sell-offs again provide more opportunities to the upside rather than to the downside. So when we look at energy, this is an energy chart. We've broken out above from the trend. It consolidated for just a couple of days and continued to accelerate here to the upside. Energy will likely, reach this 56.5 recent high here in the short run, and then and this is a major resistance level here in the long run. And if it does break out above that level, it really is constructive up to 62.5 potentially, kind of completing this giant bottoming formation here for XLE. I don't necessarily think long term that energy is particularly a strong sector to be in, but we certainly see some short-term strength that's worth taking a look at. Utilities recently touched the 63.5 support level here, so our expectation is for potentially of a small bounce higher here, especially in a higher yielding, especially if yields start to stabilize here. Utilities could see a little bit of a stabilization. May not be a strong bounce here, but some stabilization. We also see consumer discretionary continuing to lose momentum on this continuation higher here as we make higher highs in price. As you can see, momentum makes higher lows in momentum, and things are starting to look a little bit weaker here, and certainly look like they're ready to start testing some support levels here to the downside. So this is one that I'm watching potentially for some further downside as we look for opportunities in this market. Consumer discretionary is certainly one where I would look for some potential downside opportunity. And then staples, especially if we look for value stocks, you're going to find some here in the staples space. Staples, looking from a price action perspective, looks like it's found a little bit of a support here. Could see a bit of a bounce here. I wouldn't play for a big bounce, but certainly, finding some support and potentially not moving significantly lower is what I would play for here for staples. And so when we look at some opportunities here in the market, this is really where you have to be a little bit contrarian, in my opinion, because a lot of charts look like this. And I think it's easy to just say, oh, I think this is going to continue moving south. But, we have to look at some of these moves, right? We've seen some big moves here. Johnson & Johnson initially sold off to about the 173 level here or so, then reached about 165 or so, tried to find a little bit of support and then fell off again here into the 150, 160 level here or so. So 3 major kind of sell-offs here. And the question is, are we near the end? We look at momentum indicators. We're starting to see a little bit of divergence here, positive divergence, and we're starting to approach prior support levels. This is really one where there could be some upside here on some of these pharmaceutical names that have sold off pretty heavily, especially when you look at a longer term chart. As you can see, Johnson & Johnson is approaching some major major support and resistance levels that have held historically. So this is one that I'm looking for potentially some bounce here on a stock that's fairly severely oversold on pretty much all time frames here, whether you're looking at a longer or short-term chart, especially if you believe in the fundamentals of a company like Johnson & Johnson. When you take a look at a stock like Cadence Design Systems, this is a similar type of price action, just very steep sell-off here from 168 all the way down to 148 or so. And what we've approached is a prior support level, a prior known support level here that was priorly resistance. And the question is looking for a potential bounce. And I think that in this type of market environment where things are looking so weak, you can look for some of these stocks that have approached major support levels that have strong fundamentals that may look for a bounce here along these levels. It's not these are obviously more speculative in nature because stocks that have fallen so much here very well could see a small bounce and continue to move lower here. So this is really where it's more important to look at your risk to reward, right? Because if you have a bounce back up to the 158, that's about a $10 move here to the upside. But if it starts to break down into the 144s or so, I would start cutting my losses. So your risk to reward ratio just simply favors your move here to the upside. It doesn't say that we're going to necessarily bounce, but the risk to reward favors an upside versus the downside. You only have to risk a couple of bucks to the downside, about $4 here to the downside, to try to potentially make 10 if you do get that bounce here to the upside. So that's how I'm looking at some of these names, and I think that's the approach that you need to take when you see stocks that are severely oversold like we've seen over the past few days. On the same token, you still have some industries that are showing some strength in this weakness. General Mills is an example of this, especially when I talk about looking for strength here in the staples space. As you can see, General Mills on a small downtrend here over the past few months, found some breakout, came back to retest this level of support, and is now starting to break out higher here. However you want to draw your lines, what we have here is a strong breakout here on relatively strong volume here as well. So you've got some volume behind it, and this is one that I think has some potential upside if you're looking for more value-based names in the staples space. General Mills certainly starting to break out here on strong volume is one of the candidates that I would look for. As you can see, momentum has been fairly negative for quite some time, recently just turned positive on the long term, and the short-term momentum turned positive about a week and a half ago. So both confirming kind of a positive move here to the upside. Same thing here in the airlines, UAL, United Airlines, breaking out above this $50 level here, I think on Friday. Had a bit of a, kind of consolidation here yesterday, but we've seen strength here out of the airlines. We've seen TSA data. We've seen the pent-up travel demand, if you will, from travelers. There seems to be strong demand going into the end of the year. So looking at a balanced approach, I think having some I wouldn't put all your eggs in one basket in a single airline, but looking at some of the more leveraged airlines gives you potentially some more leverage here to the upside. United Airlines, American Airlines, these are some of the more highly levered airlines versus some of the more better operated airlines like Southwest Airlines. They're going to be, I think, a slightly safer investment towards the end of the year, but they're not going to have the same amount of upside in some of the more better run airlines. But I think if you're looking for a recovery in the airlines, it makes sense to have a mixture of different airlines rather than just putting all of your eggs in one basket for a single airline. And then on the flip side, as we talk about that rotation from value, from growth into value, so the rotation from growth into value also means that some of the growth names have to come lower here. And there's one that came that I think the chart setup looks extremely interesting is Fortinet. Fortinet currently is trading at a fairly rich valuation, and it just completed what looks like a pretty, I would say, textbook head and shoulder formation here. Two shoulders around 310, head around 320 or so, and right now we're testing the neckline. The momentum has already started to turn negative here. We've seen the daily momentum turn negative here about a week ago. Weekly momentum is still positive here at the moment, but as you can see, it's hanging on here. The short-term moving averages have started to flatten out here. and it is potentially at risk of breaking down. And what's really interesting about this from my perspective is that you have a lot of room here to the downside, potentially all the way down to 210 or so on FTNT. So this is one that I am watching for a potential break lower here. This could happen today. This could happen later this week. But this is one that I would put on my watch list and look for a potential break below this 285 level. A break below 285, that would be my signal to potentially enter and signal the fact that this head and shoulders formation is complete and we are potentially headed for significant downside. Now you have a similar price action. I wouldn't quite call it a head and shoulders here, but similar topping formation you see in Snowflake. Snowflake also, as you can see, moving averages have already started to turn lower here. You have momentum that is starting to turn negative here on the daily chart. It hasn't broken below this 290 level here, but this is also one very similar chart setup. A break below that certainly would potentially target 270 and potentially 250 here to the downside, especially at some of these growth tech stocks, higher beta tech names that are not profitable. These are the types of stocks that you're likely going to see some further downside as interest rates rise. So this is one that I'm also paying attention to. And then you have names like Costco. Costco, very similar price action, but actually has already broken this trend line here in terms of Costco, breaking below this 445 level here to the downside. Not only has it broken the support level, it also broke the 50-day moving average. So you really have a stock that has been one of the best performers in the markets, in the retail market from the pandemic lows. This was a $280 stock that reached 470, 470 or so, and formed this double top here at about 470 and is now starting to break below some major support levels. We could see a bounce back into this range over the next couple of days. If it does that, that certainly is constructive. But from my perspective, momentum, as you can see on the daily, momentum has turned negative. So I cannot help but think that there's further downside here for Costco. And Costco, as you can see, had a pretty strong run up here. So the risk to the downside is fairly significant all the way down into the 390 level here for Costco. Same thing here for PayPal. This is really the type of stock where you continue to see some downside here after a little bit of consolidation, continues to accelerate here to the downside. Costco, in my opinion, has some downside all the way into the 230 level here or so. The weekly momentum has turned negative. Daily momentum has been negative for quite a few weeks now. And after the pullback to the 21-day moving average, that rejection, I think, is a sign that there's further downside here for PayPal. So, and lastly, I'll leave you with another tech name, Snapchat. Snapchat, one of the best, I would say, performing tech stocks over the past, since the pandemic lows, right? So we're talking about an $8 stock that reached an $80 stock here just a few weeks ago. This is 100% return, right? I'm sorry, 1,000% return. So from when you look at that from that perspective, we certainly start to see momentum decelerate. Higher highs in price, lower highs in momentum. Same thing here on the daily chart. Higher highs in price, lower price, highs in momentum. So it has pulled back here and it's back to test the $70 level here, which is also a gap fill level. It gapped higher here and has held this level multiple times. Is it potentially at risk of a pullback here? I certainly think this is a potential candidate for that. First level here to the downside would be the gap level, 64. So you're looking at a pretty sizable vacuum here between 64 and 70. So I think if we break below 70, it's headed to 64 fairly quickly. So those are some of the names that we're paying attention to here right now in the broader markets. As you can see, overall equity markets, while looking bearish here, there is some signs of improvement here over the past few days. But like I said, there's a bifurcation that we started to see between value versus growth. And I think that's really how you want to think about the broader markets as you look for opportunities over the next week or so. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next Tuesday on our next Tuesday morning market outlook session. Thank you so much and have a great trading day.